Dinkle Manufacturing Corporation accumulates the following data relative to jobs started and finished during the month of June 2008. And you see on this slide we have cost and production data dealing with items such as raw material unit cost, direct labor payroll, direct labor hours worked, other items as well, and it's broken down so that we can see there is actual data available and standard data available. Now, in the paragraph right above the instructions, it lets us know that overhead is applied on the basis of standard machine hours. 3 hours of machine time are required for each direct labor hour, and the jobs were sold for $400,000. Selling and administrative expenses were $40,000. Assume that the amount of raw material purchased equaled the amount used. And with that said, we're asked to solve 3 different tasks. We're to compute all of the variance for direct material and direct labor. Then on B, we're to compute the total overhead variance. And on C, we're to prepare an income statement for management, and we get to ignore income taxes. Okay, now I've shrunk the problem so that you can still read it, but it still gives us some room at the bottom of the slide to illustrate how we'll compute the variances for direct materials and direct labor. And on this slide, we'll tackle just the material variances. Now we can compute total material variance by taking the actual quantity times the actual price. And they gave us in the problem 10,600 units used at a price of $2.25 per unit. So we're able to compute total material variance of $23,850. When we multiply the standard quantity of 10,000 units times the standard price of $2 per unit, we come up with 20,000. Since $23,850 is greater than 20,000, we have a 3,850 unfavorable total materials variance. Well, let's break that down into price variance and quantity variance. To determine the price variance, you take the actual quantity times the actual price and compare that to the actual quantity times the standard price. So when we drop in the numbers, the only number that changes is the actual price of $2.25 versus the standard price of $2. So actual quantity times actual price is $23,850. Actual quantity times standard price is $21,200. We have a $2,650 unfavorable variance. Now let's take a look at materials quantity variance. And how we compute a materials quantity variance, we take the difference between the actual quantity at standard prices versus the standard quantity at standard prices. So the actual quantity was 10,600 units and the standard price is $2. The standard quantity is 10,000. So when we do the multiplication that you see that actual quantity times standard price is $21,200, while standard quantity times standard price is $20,000, and we have $1,200 of an unfavorable variance. Adding the materials price variance, which was unfavorable of $2,650, to the materials quantity variance, which was unfavorable by $1,200, gets us the total materials variance, which was equal to $3,850. And this works because the amount of raw materials purchased was equal to the amount used. Had we purchased an amount that was greater than the amount used, then we'd have to use different quantities for the standard quantity calculation, and as a result we couldn't just add the material price variance to the material quantity variance to come up with total materials variance. We'd have to make an adjustment since the price variance is computed at the point of purchase and the quantity variance is computed at the point the goods are used. Now let's look at the total labor variance. And the total labor variance is found by multiplying actual hours times actual rate and then comparing that to standard hours at standard rate. So the actual hours was 14,400, which was given, and we have an actual rate of $8.50. And we calculate that by taking 122,400 of direct labor payroll dollars and dividing it by direct labor hours worked. So we wind up with $122,400 of actual direct labor cost, and then we compare it to the standard hours, which was 15,000 times a standard rate of $8. And the $8 is calculated by taking the 120,000 of the standard payroll dollars amount they gave us and dividing it by the 15,000 of the direct labor hours worked at standard. Okay, so we come up with an $8 rate times 15,000 standard hours, or 120,000. The $122,400 of actual cost compared to the 120,000 of standard direct labor payroll gets us an unfavorable variance of $2,400. Now let's break the total labor variance into its component pieces. First we'll look at the labor price variance. And the labor price variance is calculated by taking actual hours times actual rate, which we've already worked through how we derived the 122,400 when we looked at the total labor variance. And now that we know the actual hours and the actual rate and the standard rate from what we calculated when we looked at total labor variance, we then multiply the actual hours times the standard rate. And when we do that, we get 14,400 actual hours times $8 at standard, or $115,200. When we subtract the $115,200 from the 122,400 of labor price variance, we come up with an unfavorable variance of 7,200, and this is all labor price variance. Now let's look at labor quantity variance. Labor quantity variance, we start off with the right-hand term of the labor price variance, which is actual hours times standard rate, and that's $115,200, which we calculated just a minute ago when we looked at the right-hand term on the labor price variance. And then we compare that to standard hours at standard rate. And earlier, from the total labor variance, the right-hand term, we calculated that as being 15,000 hours times $8. Okay, so we have actual hours times standard rate equal to $115,200, which is less than the $120,000 that we get when we multiply standard hours times standard rate, and as a result, we have a favorable variance of $4,500. Now when we add the $4,500 favorable variance to the $7,200 unfavorable variance, what we wind up with is a $2,400 total labor variance of that's unfavorable. So you can see that on this slide we've broken down the total labor variance into its components, the labor price variance and the labor quantity variance. On this slide we'll tackle part B, which asks us to compute the total overhead variance. Well, actual overhead was $184,500, and overhead applied is equal to $189,000, which was given. So the total overhead variance is just the difference between the two, and since actual is less than overhead variance, we've got a $4,500 favorable variance. Now another way of calculating overhead applied variance would be to take the 45,000 units times $4.20. And if we use that approach, you come up with the overhead applied amount of $189,000. The final step of this problem asks us to prepare the income statement. And you see Dinkle Manufacturing Corporation's income statement on the right side of your screen right now. What we have is sales less cost of goods sold at standard to come up with a gross profit at standard. And then we have to add in the variances that we've calculated to compute gross profit at actual. Below that we see selling and administrative expenses and net income. By the way, this would be for an internally prepared income statement. For an externally prepared income statement, all of those variances would most likely be included as part of cost of goods sold. Okay, now I'll identify the variances that we calculated earlier, and draw lines showing you where those dollar amounts come from and where they show up on the income statement.